Hello, everybody. Good day and welcome to Mastermind number 79. My name is Hanif Brown and I am happy to be your host here for today. This is about personal development, investing, real estate, and investigating the market of cryptocurrency. So let's see what we have on our agenda for today. So we've been continuing with Rich Dad Poor Dad. We're now chapter 7 on getting started, using assets to buy luxuries, and the power of focus. That's what we have there in terms of personal development and financial education. With regards to investing, we're at the letter U. We're almost completed the alphabet, and we're talking about underwriting in real estate. What exactly is that in terms of for investors and lenders? From a cryptocurrency standpoint, we're talking about unrealized profit and loss. What exactly is that? And as usual, we're going to talk about the market updates of real estate and cryptocurrency. So, how exactly again did we start? As a disclaimer, the content here is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. I'm not a licensed financial advisor, not a CPA, and not a lawyer. Please consult a licensed professional before making any decision. There are risks associated with investing in securities, investing in stocks, bonds, ETFs, mutual funds, and money market funds involves risk of loss. This meeting was inspired by Think and Grow Rich as to what exactly Napoleon Hill describes as a mastermind group. If you never read that book, then I strongly suggest you take a read if you're looking at understanding more about the world, how to achieve success, and accumulating whatever that may be, if it's money or whatnot. So let's jump into a bit of real estate now. Um, we'll start with that. So we're talking about underwriting. What exactly is underwriting in real estate? And you can find all of this information free online. I keep doing this so you can know that how simple it is actually to find out about different things and with regards to information. So talking about underwriting, but actually I should probably actually yeah, let's go ahead with the real estate market. So what exactly is underwriting? So real estate underwriting definition, how exactly it works, and the history of underwriting. So Lloyd's of London is credited as the entity that came up with the term underwriting. The English insurance broker, which dates back to the 17th century, gathered individuals to issue coverage for risky ventures such as sea voyages. I mean, that's pretty risky. Really risky, actually. You could get eaten by sharks, you could drown. Um, your boat could get like damaged by the waves. That's a lot, actually. Come to think of it. So underwriting is the process lenders use to determine the credit worthiness of a potential customer. So the underwriter researches to ensure applicants represent themselves truthfully and to get a sense of the applicant's finances. So how it works is that it refers to the process the lender uses to determine your credit worthiness. So, should we actually loan money to this person? It's a very important in the financial business because it helps determine how much of a premium someone will pay for their insurance, how fair borrowing rates are set, and also sets prices for investment risk. So underwriters have quite the role there when it comes on to dealing with real estate. So they conduct research to ensure the applicants represent themselves truthfully and to get a sense of the applicant's finances. For real estate transactions, underwriters also determine whether the property's sale price meets the appraised value. So uh, you want to sell this property for X amount, but how close is that to the actual appraised value of the property? So talking a little bit more about it, and this is not just a real estate kind of thing. You're talking about also in businesses as well. So when an individual or business entity seeks funding for a real estate project, the loan request is scrutinized by an underwriter to determine how much risk the lender is willing to accept. For example, what's the loan to value that you're going to be getting? Is it 80%? Is it 70%, 75%, 60%? So these types of underwriters are not to be confused with securities underwriters who determine the offer price of financial instruments. So underwriting, again, in and of itself is a term in the financial industry. There are different ones. For example, there's for real estate. And as you can see, there's a different one in terms of securities. So borrowers are required to have an appraisal conducted on the property. The underwriter orders the appraisal and uses it to determine if the funds from the sale of the property are enough to cover the amount lent. For example, if a borrower wants to purchase a home for 300,000 and that an appraisal deems to be worth 200,000, the underwriter is unlikely to approve the loan, or at least a loan of the full 300,000. So there you saw where the appraised value came in way lower as to what the person wants to buy the home for. So they also make sure the factors of the property are in check. This includes ensuring there's no one else on title and whether there are any dangers to the property due to natural disasters such as floods or earthquakes, for example. In most real estate loans, the property itself is used as collateral against the borrowed funds. So when underwriters generally use the debt service coverage ratio to determine if a property is able to redeem its own value. So uh, what this looks like is that you will have, for example, and the debt service coverage ratios that people are looking for, most institutions is, for example, a 1.2. So you have the property's value, you have the amount that you're looking to borrow, there's the initial investment, there's the income coming in from the property, there's your debt that you're servicing. So that's what the debt servicing is. How much exactly is the mortgage for this property going to be? How much income is coming in? If you're looking at it's 1 to 1 and you're barely breaking, you're just breaking even, then, you're probably not going to have such a high debt service coverage ratio. And the underwriter may not be so happy with that. They may not want to lend based on that. And so, where does this process come in? So, let's say you're acquiring a deal, and it depends. Each person that goes about this differently, depending on what it is that you have going on. So, you found a good you found a good deal or created a situation for a good deal. You've done an inspection, for example, right? And you're going to the bank now, and you're saying, well, you go to a mortgage broker, and you're looking at getting a mortgage. And so, let's say, for example, you're dealing with a commercial property, 5 units and above. At that point in time, your underwriter is looking at, they're saying, okay, um, give me these expenses. What's the income of the property? They'll probably ask you maybe also for some more information. Is this the verified information in terms of what the current rents are, right? They'll also assess things in terms of the income that's there for dealing with commercial buildings. And so when they look at that, they're saying, well, based on these numbers, we come back with a debt service coverage ratio of, for example, 1.1. When we're looking for a 1.2 or a 1.3, the higher debt service coverage ratio, the better it is in terms of your chances of getting approval in terms of you're getting a higher loan to value. If not, then you might have to come up with a little bit more upfront. So we can go into calculating the debt service coverage ratio. That's a whole other thing, right? And talking about what each lender is looking for, as each lender is different, but you want to consider this as something when you're looking at acquiring different buildings. For commercial buildings, it may be different. Well, it is different, as they'll talk more about the debt service coverage ratio, and they'll talk about how exactly the income of the building itself is able to cover the expenses. If you're looking at buying a residential property, then you're looking at a different situation in terms of where you, the applicant, are scrutinized a little bit more, right? It's not about the building. It's more so about what exactly, your income is, what assets do you have, right? And is this, a purchase that you're actually able to afford? And in different situations, let's say interest rates go up, etc., and more. So that's what underwriting really looks like. We could go into different examples and more, but this gives you a kind of, basic introduction in terms of what exactly it is that, what underwriting is. You want to do your underwriting as a real estate investor, and you want to assess different things. You want to assess factors in terms of rent growth, the vacancy rate of the area, cash flow forecast, and your potential returns actually. So you want to do your own. You don't want to leave it up to just the underwriter. You do your own underwriting in terms of what are you looking for this building, right? What's the potential growth in terms of what it is that you can get in terms of with this building, in terms of the rents, how can you decrease expenses and more? Because the underwriter is just looking at getting you that financing. but you need to have a plan and an exit strategy in place as to what's your plan for the building. Or you're going to optimize, for example, the net operating income. And so that's a whole different thing in terms of learning, how to do that. So that's what underwriting is. That's not a full-on, deep dive. That's just an introduction. So, learn how to do underwriting. If you don't understand exactly how to do that, then, you can feel free to reach out and they can point you in terms of resources that help you in terms of doing that. And so let's talk a bit more about in terms of news that's going on in the real estate market. New Canadian mortgage rules to have little impact on housing. So that's what BMO is saying there. Let me jump into this one. Let me click on this. This week's top story, Canadian real estate sellers surge and the bad news for mortgage rates. So a lot more people are getting a lot more people want to sell. And I mean there's no snow outside. Well, at least where I am. And so you'll find that this market is normally a busier market because for whatever reason, there are different reasons. I figure, well, a lot more people are probably more willing to move in the summer. And so you'll find that there are probably a lot more properties trading hands. Canadian real estate prices slipped, but inventory jumps in April. So sorry, there were price decreases, but inventory increasing. That does not sound like a really good situation. Bank of Canada, just in terms of for long-term investing. Bank of Canada, well, depending on how you look at it, really, I should say. Bank of Canada just delivered bad news for mortgage rates. Yields surge. Canada to cut interest rates before US as labor market erodes. That statement there from BMO. Canada tries to bail out real estate developers with 30-year mortgages. So we're seeing normally it's probably 25 years, and you're seeing where longer amortization. So, you're giving people a lot more time to pay off money. Canadian mortgages just had one of the slowest quarters ever. Not looking great for GDP in that aspect. And so all these factors are inversely, well, not, well, I should say inversely, directly related, inversely related. It's all one big web of relationships in terms of economics here. So let's see what all of this really means. And obviously, this is not all of the news, right? But Canadian real estate prices slipped. Inventory jumps in April. Canadian real estate did not move much last month, but the data still hints at an interesting spring. The price of a typical home slipped 0.3% lower in March. The month also showed a mild increase in sales. So now we're dealing with a kind of environment, remember here, people, where rates got lower some time ago, and we're seeing where rates are higher now. There is a lot more in place in terms of banks are being a lot more stricter in terms of who they lend to. Right, so that's going to be something that impacts different things. People, times are getting harder, inflation is up. People have less money to invest. People have less money to spend, right? Diving into more detail, the distribution is the interesting part. New listings began to surge towards the end of the month. So, maybe it's like the sun is coming out. A lot more people are like, look, I'm looking at maybe selling my home. If rates were up and you were on lower rates, realistically, many people are dealing with higher rates. Their pay hasn't increased. However, cost of living has gone up. And if we're talking about cost of living, one of those big factors in terms of credit is, a mortgage. Many people may not be able to afford their mortgages right now, whether it's real estate investors or people may be living in their homes, and that's not a great thing, right? And so, but it is what it is, though. CREA made a point to note of the first week of April saw oops, 1 second, let me just do this. Made a point to know the first week of April saw a flood of new listings. The question now is whether those listings can be absorbed by the market. So, are people actually going to go ahead and buy these listings? Can the market actually absorb these listings? Bank of Canada just delivered bad news for mortgage rates. Yields surged. We know we're expecting the central bank to deliver good news for mortgages, but they got the opposite. Canada to cut rates before US as labor market erodes, BMO. And you want to pay attention to these updates from the big five banks, right, in Canada. Canada tries to bail out real estate developers with 30-year mortgages. GOC is announcing more demand side stimulus for first-time buyers. In response to soft new home sales, the government of Canada will allow 30-year mortgage amortizations to increase potential activity. So the Canadian government is looking at stimulating that activity there in the real estate market. They're also dramatically increasing the amount first-time buyers can withdraw from their registered retirement funds to provide a down payment. So people don't have cash readily available. Where do they have it? In registered retirement funds. So they're looking at increasing that amount so a lot more people can access a lot more in terms of it wouldn't be cash flow or credit, but their own money. Um, I probably maybe reduce the taxes on that there as well to incentivize a lot more people. The changes are good news for those selling homes, but risk concentrating the economy into housing even further, especially the last part, since they're literally encouraging people to withdraw retirement funds from capital markets and put it towards housing. Not because you can means that you should. Not because they say that you can. You need to assess your own situation personally and say, hey, is this a good decision for me to actually withdraw the money from my retirement fund and put it into housing? It may not be for you, it may be for you, but definitely you see moves there from the Canadian, well, not the central bank and the government in terms of stimulating activity in the economy, primarily in housing. So interesting times here in Canadian real estate. Definitely a change, and we must adjust to that change. New Canadian mortgages to have a little impact on housing. So, Canada has been looking at making different changes. According to BMO, the changes you guys are making aren't gonna have a lot of they're gonna have little impact there on housing. So again, not looking so positive there in terms of news with Canadian real estate. However, there are opportunities that are there and available. Uh, Actually, not however, there's more volatility, so that makes it even more interesting in terms of opportunities, right? Many see danger and some see opportunities. So actually, I'm going to pause there for now in terms of the real estate standpoint. And so we're seeing different things here. So we're talking about underwriting, what exactly that looks like as a real estate investor, underwriting on what exactly that looks like, for people as a lender. So let's jump into section 2 where we're talking about rich dad, poor dad in terms of personal development as well as financial education. So we've been continuing with our series here with Kiyosaki. What exactly the rich teach their kids about money that the poor and the middle class do not? So we've been on the chapter in terms of getting started. We started out this book and now we are on this chapter. So let's see where we started from. So we started with how the rich do not work for money. Lesson 2, why teach financial literacy. And lesson 3, minding your own business. Lesson 4, the history of taxes and the power of corporations. Chapter 5, in terms of how the rich invent money, working to learn, not working for money. Chapter 7, overcoming obstacles. Chapter 8, getting started. And that's where it is that we are right now. So let me see, can find there. So we went over paying your broker as well and the power of good advice. Last week we went over being an Indian giver and the power of getting something for nothing. What exactly is Kiyosaki talking about when he talks about that? Where exactly does ROI come into that? We'll remember the famous quote in terms that he made: the sophisticated investor's first question is, how fast do I get back my initial investments? How fast do I get my money back? Now we're on part 8 where it talks about using assets to buy luxuries and the power of focus. So a friend's child has been developing a nasty habit of burning a hole in his pocket. Just 16, he wanted his own car. The excuse? All his friends' parents gave their kids cars. The child wanted to go into his savings and use it for a down payment. That was when his father called me and then came to see me. Do you think I should let him do it? Should I just buy him a car? I answered, it might relieve the pressure in the short term, but what have you taught him in the long term? Can you use this desire to own a car and inspire your son to learn something? Suddenly, the lights went on, and he hurried home. 2 months later, I ran into my friend again. Does your son have his new car? I asked. No, he doesn't. But I gave him $3,000 for the car. I told him to use my money instead of his college money. Well, that's generous of you, I said. Not really. The money came with a hitch. So what was the hitch? I asked. Well, first we played your cash flow game. We then had a long discussion about the wise use of money. After that, I gave him a subscription to the Wall Street Journal and a few books on the stock market. Then what? I asked. What was the catch? I told him the $3,000 was his, but he could not directly buy a car with it. He could use it to find a stockbroker and buy and sell stocks. Once he made $6,000 with the 3,000, the money would be his for the car, and the $3,000 would go into his college fund. And what are the results? He asked. Well, he got lucky early in his trading, but lost everything a few days later. Then he really got interested. Today, I would say he's down $2,000, but his interest is up. He's read all the books I bought him, and he's gone to the library to get more. He reads the Wall Street Journal voraciously, watching for indicators. He's got only $1,000 left, but his interest and learning are sky high. He knows what if he loses that money. He walks for 2 more years, but he walks for 2 more years, but he does not seem to care. He even seems uninterested in getting a car because he's found a game that is more fun. Key thing there. Key thing there. One, this parent was actually willing to go ahead and ask for help from somebody who educates people on their finances with Kiyosaki. And Kiyosaki has already built this cash flow game. And we saw where it is that, the father took the advice, or father or mother took the advice and went ahead and they implemented it. And look at that, the guy, instead of buying a car, went ahead, learned different things, and now he's making money in terms of the stock market. Whether or not he becomes consistently profitable is a whole other thing. He's not even so much interested in the car. Many people may be looking at this and saying, I don't even have $3,000 to loan my kid. Well, here's a classic example, right? And the cash flow game costs almost close to nothing. It's not an expensive game. Uh, we'll cross that bridge when we get to it. I'd rather have him lose everything now than wait till he's our age to risk losing everything. And besides, that's the best $3,000 I've ever spent on his education. What he's learning will serve him for life, and he seems to have gained a new respect for the power of money. As I said earlier, if a person cannot master the power of self-discipline, it's best not to try to get rich. I say this because although the process of developing cash flow from an asset column is easy in theory, what's hard is the mental fortitude to direct money to the correct use. Due to external temptations, it's much easier in today's consumer world to simply blow money out of the expense column. With weak mental fortitude, that money flows into the path of least resistance. That is the cause of poverty and financial struggle. The following example illustrates the financial intelligence needed to direct money to make more money. If we give 100 people $10,000 at the start of the year, I believe that at the end of the year, 80 would have nothing left. In fact, many would have created greater debt by making a down payment on a new car, refrigerator, electronics, or a holiday. 16 would have increased that $10,000 by 5 to 10%. 4 would have increased it to $20,000 or into the millions. We go to school to learn a profession so we can work for money. It's my opinion that it's just as important to learn to have money work for you. I love my luxuries as much as anyone else. The difference is I don't buy them on credit. It's the keep up with the Joneses trap. When I wanted to buy a Porsche, the easy road would have been to call my banker and get a loan. Instead of choosing to focus in the liability column, I chose to focus in the asset column. As a habit, I use my desire to consume to inspire and motivate my financial genius to invest. Too often today, we focus on borrowing money to get the things we want instead of focusing on creating money. One is easier in the short term, but harder in the long term. It's a bad habit that we as individuals and as a nation have gotten into. Remember, the easy road often becomes hard, and the hard road often becomes easy. The earlier you can train yourself and those you love to be masters of money, the better. Money is a powerful force. Unfortunately, people use the power of money against themselves. If your financial intelligence is low, money will run all over you. It'll be smarter than you. If money is smarter than you will work for it all your life. To be the master of money, you need to be smarter than it. Then money will do as it is told. It will obey you. Instead of being a slave to it, you will be the master of it. That is financial intelligence. Wow. Well said. Well said. Well said, Kiyosaki, in terms of how this relates to people and their everyday lives. Putting the chapter into context, what exactly are we seeing here? Use assets to buy luxuries and the power of focus. So, summarizing and using the example that he gave, the luxury here and the example that was used was how this kid came up to his dad and said, hey, he wants a car because all his friends' parents are buying them cars, or he wants to maybe get a down payment for a car. What the dad did is that first, he sought help. He actually went to Kiyosaki and asked for help. How many people actually go ahead and ask for help? He wasn't sure what to do. And this is a common thing I've found with people who are very successful. They ask for help. They don't keep things to themselves. If they need help with something, they'll go ahead and ask. It's actually people who are less successful, I find that they actually don't ask for help. They don't consult experts, right? They want to kind of do it themselves. And I mean, not, throwing my stone at anyone. I'm just talking about things it is that I have observed, right? They understand the power of a mastermind. They understand the power in terms of, paying for the right kind of advice. And so that was key. So after that, the kid went ahead and played the cash flow game. And then his dad gave him $3,000. Say, hey, you can do whatever it is that you want with it. But actually, go ahead and you can learn to invest it and everything. And only if you make $3,000, then you can use that $3,000 to buy a car. The kid got so invested in it. He's been making money. He's been losing money. He's been so focused. He's not even so much interested in getting a car anymore. He's fine walking wherever it is that he wants to go. And so he actually wanted to go into his savings to pay for the car. So whether or not he even ended up getting that car, now he has a kind of idea where he now can go ahead and acquire assets to actually go ahead and buy the car. Once those assets are cash flow producing, right? He can go ahead and use that money to go ahead and buy a car. And that's how it is that you go ahead and you utilize your assets to buy luxuries, and that power of focus. And Kiyosaki shared here, if we scroll back here, if you give many people think their problem is money. I'm gonna plug in my computer. Many people think that their problem is money. In a lot of cases, it is not. Well, what would you want right now? I would want $1 million. Your problem isn't money. Your problem is your relationship with money. And that's something that many people have to look in the mirror and, maybe look at themselves and say, maybe I don't have the best relationship with money. And that's okay. If you give 100 people $100,000, $10,000 at the start of the year, by the end of the year, 80 of them would have nothing left. Why? Likelihood, they were not financially educated, right? They would probably maybe even create greater debt because their relationship with money is that you get money, you buy depreciating assets. You want a new car, you want a nicer this, you want a nicer that, as opposed to investing it in assets, or, they'll save it. There's another portion of society where 16 of them would go ahead and, they'd go for the safe thing, right? And this is actually better, right? Because, losing money is a whole other thing, right? But you're not getting hurt by saving money and putting it in a safe place, right? then four of them would go ahead and increase it to $20,000, or even into the millions, because they would go ahead and find different ways in terms of doing that, investing it in cash flowing assets, right? So we go to school to learn a profession so we can work for money. It's his opinion that it's just as important to learn how to have money work for you. And how exactly do you go about doing that? So a great chapter there in terms of what he talked about in terms of utilizing your assets to buy luxuries. And a very good example there he used. So we'll pause there for now in terms of Rich Dad, Poor Dad. And next week, we continue with, here we go, choose heroes and the power of myth. Choose heroes and the power of myth. So that's what we're saying. So we talked about underwriting in real estate, Canadian real estate market. We talked about rich dad, poor dad, using assets to go ahead and buy luxuries. And now we're talking about unrealized profit and loss. So what exactly is that here we're talking about in the cryptocurrency market? So what is unrealized profit and loss? Unrealized profit and loss occur when you have a position open in a security that has appreciated or depreciated in value. That is also known as paper profits or losses, because you don't actually realize these gains until you sell the security. So let's use an example. So I'll tell you what this is simply before I go into this explanation. I don't think I'm going to go over all of it actually. You bought, for example, let's look at the crypto market, right? What exactly is your unrealized profit and loss? So let's say it is that you bought, for example, Bitcoin at 30 something thousand, right? Now the price of Bitcoin is 63,000 something. You have seen 100 and something% increase on what it is that you invested on your initial investment. However, you have not sold. So you have made you're seeing profit, but it is what's called unrealized. Why? Because you have not yet executed a sell order on that security or on that asset. So there's profit, but it is unrealized, right? The same thing with a loss. Maybe you bought Bitcoin at, for example, $70,000. And that means that currently you would have been down. If you bought at that price, let's say you bought $100 worth, you're down to maybe like 96, 97 or whatever now. So you have an unrealized loss. You have not sold. And that's why it is that they talk about in cryptocurrency that, or even in investing overall, you lose only when it is that you sell. If you haven't sold, then you haven't lost, right? And this is important to consider because you're playing a long-term game when it is that you're looking at buying, for example, cryptocurrency or, stocks or even real estate. Markets are not, don't go up all the time. Markets go up and markets go down. And so that's what we're looking at there in terms of unrealized profit and loss. In some exchanges, they will show you what exactly your unrealized profit is, what your unrealized loss is, and you'll be able to see what exactly that is. So to illustrate, assume an investor purchases 100 shares of company XYZ for $50 per share. That's a $5,000 investment. After holding the stock for 10 years, it has increased in value to $100 per share. The unrealized profit on this investment would be, that's 100 shares times that's $100 as to what the future price became, or what the future price is, and $50 as to what you bought it for. So you're seeing $5,000 in unrealized profit. When you then sell, you would have seen $5,000 profit, right? So it's a profit or loss that has occurred on a commodity contract, futures contract, option contract, or any other financial instrument, but has not been realized because the position is still open. So questions that people frequently ask me, do you pay taxes on this crypto that you have unrealized profit in? Well, if you haven't sold, well, consult a licensed financial advisor, talk with your accountant. However, let's use the basic example that you bought, for example, Bitcoin when it went down to $30,000 last year, and now it's at 60 something thousand dollars. You haven't sold. You're thinking, well, it's increased in price. I've made money. Well, in theory and on paper you have, but until you execute that sell order, you have not triggered a taxable event, right? Your profit is unrealized. When you hit that sell button now, then you would have realized some amount of profit. And so that's how exactly it works, right? Um, so you're this is very good in terms, well, not very good. This is, tracked in terms of accounting, and especially true for day traders who tend to trade as much as they can during the market's open hours or even after hours. So key there in terms of understanding what exactly unrealized profit and losses. If you go into your exchange accounts and you look at different assets you have, you'll actually be able to likely see what your unrealized profit and loss is on different assets. So just play around with the exchange if you have cryptocurrency, or if it is that you have, stocks, ETFs, whatever it is that you have. Spend some time in the application and understand it. They were made to make investing easy, also that you can have access to these financial instruments way simpler. Bitcoin, let's go over the cryptocurrency market now. So our halving is in 4 days, exactly in 4 days, right? Bitcoin is down 11% over the last 7 days. Ethereum is down 15%. Solana is down 23%. So we're seeing where the hype has died down. We're also seeing the fear and greed index down to 65. Last week it was up a bit more. What else are we seeing? We're seeing mostly red in the market. And when you're seeing mostly red in the market, in cryptocurrency, we'll say that that's a term of in terms of there being blood in the streets. Dogecoin is down 21%. AVAX is down 29. Cardano down 25. Bitcoin Cash down 25. Everything's down 20 something percent. I love it. I love it. I love it. Why do I love it? You have to have corrections in the market, right? Don't expect it to go up all the time. And this will, many people are looking and say, yeah, yo, it's down now. This will teach people in terms of their risk. If you're new, this is kind of normal, right? Over a 7 day period, you'll see these double digit, whether returns or losses, and you're down. So many of you, if you bought up in terms of the hype the other day, you're now experiencing what's called an unrealized loss, right? Your assets are down for right now. Near Protocol is down 28%. Ethereum Classic is down 25%. Stacks is down 26. Mantle is down 22. Everything's down. Literally, everything's down double digits. Wow. Everything's down double digits. I love it. I love it. So this provides an opportunity to accumulate a lot more. Many people would say, wow, this is not good and whatever. Well, when this isn't your first bull market and you understand, what's going on, then when you see stuff like this, you're kind of used to it. People who are new, under is up 2%, still holding. Everything's down. Literally, everything's down double digits. Red, 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 red. Blood in the streets, people. Blood in the streets. So the more experienced people, this is normal to them. If you are new, that's okay. If you just started investing in cryptocurrency, that's okay. Right? This is kind of normal to see over a period of time. Again, you're holding these assets for the long term. We're seeing Mantra, the outlier there in terms of being up 14%. Up 14%. Tether Gold is up 2%. Let's see if we have any other ones. MX token is up 8%. See many people using that. I think that's from a Mexi exchange. Many people using that exchange a lot more. Pax Gold is up 6%. Cat in Dogs World. Every time I see this thing, it's just so funny. That's up, what's it, 5%, 2%, whichever one it was. Apart from that, everything else is down. So, what should people be doing now? I'm not proclaiming to be any kind of guru or expert. I'm just telling you what I've found, more experienced people to be doing. And, there are people more experienced than myself, and I learn from them. I love learning from them. And I implement a lot of what it is that I do go ahead and learn. So, what are people doing right now? All time, what are we seeing again? We're seeing where let's look at the charts. The charts don't lie. Don't follow greed, don't follow sentiment, the charts do not lie. So once this chart comes up, you'll remember a year ago, right? Let's look at a year ago. 2023. What month are we in now? Let's see. We're in, yeah, 2023, March, April. Bitcoin was at 27,920. Now, if you can do basic mathematics, it doesn't take much for you to look at it and say that, oh, we're actually up. We're actually up, right? So, should you be buying now? Yeah, you could be, right? You could be. We're still close to our all-time high. But when you look at the chart and you zoom out, you realize that, wow, like over the past year, like we've been doing crazy stuff, we're up like 2 3x on whatever it is that money you had in. And so always zoom out and look at the bigger picture. The bigger picture is always what's important. So, should you be buying now? I don't know. It could be for you, it couldn't be for you. But normally when it is that, you see things are down, that's the time when you want to be buying, not when the markets are green. Don't buy when everything is green. You're buying into the hype. And guys like me sell during those times. And you know what happens? In order for people to make money, you need to have two sides. You have sellers and you have buyers. In order for people to make money, they need to sell. That means that on the other side, there is some buyer out there that is, taking on risk during a time when other people are selling. So the experienced people were selling the other day, you know. The less experienced, well, actually, I shouldn't say less experienced. It depends, People who are making profit, you have to sell in order to make profit, right? And so the people who were buying were like, okay, well, we're getting at higher prices. We were doing this and that and whatnot. There's nothing wrong with that. And so when things are red is when it is that you should look at buying. So that's what we're seeing in the crypto market here for this week. I'm going to pause there for now. Very interesting thing. So wrapping up and summarizing, Rich Dad Poor Dad, we talked about using assets to buy luxuries. Real estate, we talked about what exactly is underwriting in real estate. And then from a cryptocurrency standpoint, we're talking about, unrealized profit and loss. So, if you bought in the last in the hype that was going on a while ago, stay strong, right? Do not sell right now, right? That's what I would do, you know. Why? Because when you zoom out and you look at the chart long term, we're supposed to have a higher high, you know. Do I know when? I don't know when it's gonna happen, but I do know that if I look at during this time in 2017, everybody thought that this was it, like Bitcoin was at like 8, 15, 14, 15,000. Everybody thought that was it until boom, we just hit through that and we're at suddenly at 50K. Suddenly we're at 70K. So it's been at 63.4K now. Depth and vision. Where's the market going to be? Where's money going, right? We still have some big players that are supposed to come into the market. So anyway, that's that for today, people. See you again next week, same time and place. And I'm gonna stop the live stream and stop the recording for now. And I will see you next week. I'm only gonna be on Zoom now. So stop live stream and stop the recording.